Thank you. Good afternoon, everyone. Thank you for joining us today. I'm Bill Schmaltzel, a partner in Mayor Brown's Chicago office. I'm a member of the Tax Controversy Group, where I represent clients in all phases of tax controversy, including audits, appeals, and the U.S. Tax Court, as well as District Court and the Courts of Appeals. Joining me today as my co-presenter is my colleague, Mike Coppa, who's a member of our tax controversy team in our Chicago office. Today, we will cover the new regulations guidance on qualifying software development activities for the research credit. As we go along, if you would like to ask a question, please use the Q&A panel on the right side of your screen. We will make every effort to answer the questions towards the end of the webinar. If we are unable to answer your question during the webinar, we will follow up with you directly afterwards. Regarding CLE credits, we will be providing an alphanumeric code at some point during the presentation. In order to receive CLE credit, participants must record this code on the virtual sign-in sheets that was emailed to you with the log-on instructions for today's programs. With that, let's get started. In today's economy, software development is no longer restricted to a few companies whose business is creating software packages for third parties. Rather, today many companies use software to run their business and to interact with their customers. Taxpayers' ability to claim the research credit depends largely on whether such software is classified as internal use software. This has been a gap in the regulations for many years, since 1986 when those provisions came into the code. At last, we now have additional clarity on what will constitute internal use software. I think as you go through the talk today, you'll see that there now is going to be a much greater emphasis on recording what your intent with software development was at the outset than had previously been the case. The need to define internal use software dates back to 1986. At that time, Congress provided that except to the extent provided in regulations, software developed, quote, primarily for internal use by the taxpayer, close quote, was excluded from the definition of qualified research. In 2001, the Treasury made some efforts to define internal use, but those regulations were never finalized. But that's been the only guidance that we've had on what was qualifying internal use until the final regulations that were issued on October 3rd, 2016, which provide rules that it will enable, I think, many companies to avoid the more burdensome requirements for internal use software. Although, as I've said, these regulations do come at the cost of requiring taxpayers to think more carefully at the outset of their software development projects to document what the classification will be. There is also a new category of dual function software, which, as we will discuss, raises questions about what must be done to qualify your activities. Our agenda for today will first cover certain parts of the new Section 41 regulations that impact all software development projects. We will then move away on to what the classification for internal use software is, and we'll discuss appropriate strategies for you to document the classification of your particular software. Finally, we will look at the additional guidance on what constitutes the high threshold of innovation test for internal use software and discuss strategies for satisfying that test. For all of these, I think you'll come to realize that it does put a much greater premium on you taking a proactive role in working with your software engineers earlier in the process. Mike, could you now give us some guidance on how these new regulations impact the standard 4-part test for all research projects?
Certainly. So what the new regulations did not change is the fact that all software development still needs to comply with the 4-part test under Section 41D, even if it's not internal use software. And here on slide 6, we have outlined the 4 tests that you need to walk through in order to qualify activity for the research credit. First test is called the Section 174 test, and under that test it asks you whether the expenditures would be deductible as research and development costs in the experimental or laboratory sense as defined by Section 174. And regulations under that section ask if the information eliminates uncertainty concerning the development or improvement of a product. And uncertainty exists if information available to the taxpayer at the outset of the project does not establish the capability or method for developing or improving the product or the appropriate design of that product. The next test is the technical information test, asking whether the research activity was undertaken to discover technological information, which is information with a basis in the physical or biological sciences, engineering, or computer science. Third, the research is intended to be useful in the development of a new or improved business component of the taxpayer. And as we've typically found, this is typically not usually an issue for most taxpayers. Lastly, substantially all of the research and experimentation activities constitute elements of a process of experimentation. Under the regulations, a process of experimentation is defined as a research process that is designed to evaluate one or more alternatives to achieve a result, where, again, the capability or method of achieving that result is uncertain, or the appropriate design of that result is uncertain. To illustrate, we have 2 basic examples from the regulations themselves that apply this 4-part test to software development. We have here example 9 from 41-4A. In this example, we have a taxpayer who's a manufacturer, and they want to install an ERP system that runs off a single database. So the taxpayer can track orders more easily, coordinate manufacturing, inventory, and shipping among many different locations at the same time. The taxpayer evaluated its business needs and the technical requirements of the software, such as processing power, memory, storage, and network resources. They devoted the majority of its resources in implementing the ERP system to evaluating the available templates, reports, and other standard programs, and choosing among these alternatives and configuring the system to match its needs. The regulations conclude that this is not qualified research under Section 41D. The taxpayer, as described, did not conduct a process of evaluating alternatives in order to eliminate uncertainty regarding the ERP system. They simply chose among available templates and reports and other standard programs and altered them to fit its needs. And so, as described, this seems correct. The taxpayer is simply choosing from available alternatives, and there was no real uncertainty regarding the method or design.
Now, I mean, I think this is an important reminder for people. The mere fact that you are not internal use software does not automatically mean that your software development will be eligible for the credit under the traditional 4-part test. There have been a great many disputes with taxpayers over things like ERP systems, where the IRS has challenged that the way in which the taxpayers were using software development didn't rise to a process of experimentation.
Consider another example that does satisfy the requirement for design uncertainty. Here we have a taxpayer who is seeking to develop a load balancing software across a server cluster that supports multiple web applications. The taxpayer's web applications operate in a highly dynamic and volatile environment, and the taxpayer is uncertain of the appropriate design of that load balancing algorithm, given that the existing evolutionary algorithms did not meet the demands of their highly volatile web environment. So the taxpayer designs and systematically tests and evaluates several different algorithms that perform the load distribution functions that they require. Unlike the last example, the regulations conclude that this does in fact meet the requirements of Section 41. Here the taxpayer's activities constituted an elements of a process of experimentation, because first they identified uncertainties and they identified a variety of alternatives intended to eliminate those uncertainties, and systematically went about evaluating the alternatives to test which ones met its need.
Now there's two things to take away here. One is that if you think about it, your ERP development may have many of the same characteristics that are actually described in example 8. It's just really a question of which facts the IRS has picked for these two examples, and you shouldn't make a judgment that, just because it is an ERP system, you can never qualify. The difficulties of load balancing, the amount of data, can raise substantial questions which would bring you into the basic 4-part test. At the same time, you should also keep in mind that these examples are just dealing with the basic 4-part test for all software developments. These examples would seem to be internal use software, which would mean you still need to meet the high threshold of innovation tests, which we will discuss later. Now let's turn to the requirements of what types of software projects will satisfy the internal use standard and therefore be subject to the additional requirements. Mike?
The general rule for internal use software is that in order to qualify for the credit, software that is developed primarily for the taxpayer's internal use is only eligible for the credit if it meets both the 4-part test for qualifying research, as we just went through, as well as it satisfies the high threshold of innovation test. And we will go through that in more detail later on in the presentation. It's important to note here, however, that Section 41 does provide some important exclusions for certain types of software from the internal use software rules. Specifically, software that's developed by a taxpayer for use in an activity that itself constitutes qualified research is not internal use software for these purposes. Secondly, software that's developed for use in a production process or the development of a production process that itself qualifies under the 4-part test, again, that is not internal use software. And if you're developing software for those two types of uses in research, you don't have to go into the further high threshold of innovation test. So when is your software internal use software? The regulations provide that software is developed primarily for internal use if it is for use in general and administrative functions that facilitate or support the conduct of the taxpayer's trade or business. And the regulations go on to list 3 general categories of these administrative functions that constitute internal use. One is financial management. The others are human resource management, as well as any support service that supports the day-to-day operations of the taxpayer. And the regulations go on to give a little bit more detail on each of these 3 categories. Financial management is any function that involves the financial management of the taxpayer, including accounts payable or accounts receivable, inventory management or budgeting, cash management, accounting and GL bookkeeping type activities, any risk management type activities, as well as tax compliance.
Now, it is important to note that the phrase includes, of the taxpayer in making this decision, and that can have significant impacts. For example, if you're a company that's developing a tax preparation software, and you intend to be using that software to prepare clients' returns, that activity would not fall within this definition because the software is not being used for the taxpayer. You know, on the contrary side, if you were simply developing software to prepare your own tax return, that would be internal use under this definition.
Next, we have human resource management functions. These include things that you would expect to include under HR-type functions, anything related to recruiting and hiring, employee training, the maintenance of personnel and employee records, any payroll-type function, as well as the management of employee benefits. Lastly, we have support services. Support services are any other function that supports the day-to-day operations of the taxpayer, including data processing or facility services like janitorial services, marketing and advertising, graphic services, the legal department, as well as any government compliance services. We have an important example of one type of support service from the regulations that we'd like to discuss as well. Here we have a taxpayer that's a restaurant, and it's developing software for a website that provides information such as the menu items and price, location, phone number, and hours of operation for purposes of advertising. At the beginning of developing this website, it did not intend to develop the website for commercial sale or lease or otherwise marketed to third parties. It intended to use software for marketing purposes only by allowing potential customers to review general information on their website. The conclusion of this example is that this software is developed for use in marketing function or an advertising function, and therefore it qualifies as a general and administrative type function, and it is not software that's intending to be interacted with a third party, and so it's considered to be internal use software. It's important to add that the regulations go on to provide additional clarity as to what is not considered internal use software. So the three categories of general administrative functions that I described earlier are exclusive. So if you don't fall within them, you can avoid internal use classification altogether. So software, according to the regulations, is not developed primarily for internal use if it is not developed for use in one of those three categories. And then the regulations then go on to provide two primary examples of when software is not developed for general or administrative functions. One is if your software is being developed to be commercially sold or leased or otherwise marketed to third parties. And that's a clear-cut example of something that's not internal use, of course. The next example is one that's going to be very helpful for a lot of taxpayers in today's economy where you're developing software or websites that interact with your customers. According to the regulations, software is not internal use if it is intended to interact with third parties or allow third parties to initiate functions or review data on the taxpayer's system.
I view this as a big advantage for many types of app developers or people that are putting software that's sort of ad-supported software rather than sold to customers. Previously, I've seen the IRS take the position that because that type of software wasn't being sold explicitly to a third party and it resided on servers that were owned by the taxpayer or leased by the taxpayer, they needed to run the gauntlet of internal use software. I've been successful in convincing the IRS that was not the appropriate interpretation, but it certainly has been an area of conflict which these regs will resolve.
Here we have an example from the regulations of the typical case where software might interact with third-party customers. Here we have a taxpayer who is a manufacturer of various products, and they're developing software for a website with the intent to allow third parties to access data on that website in order to order products and track the status of their orders. At the beginning of the development, the taxpayer does not intend to develop the website for commercial sale or otherwise market it to third parties. And as Bill had described in the last slide, this is a very common type of app example that the regulations are providing here. This is software that's being developed intended to interact with customers, allow customers to review products, order products, and track the status of those orders through the website itself.
Yeah. There's also a very good example about a website that makes available software, photo editing programs for people to upload their photos and edit them, and they say that is intended to be excluded from internal use software as well.
It's important to be aware of how the regulations define third parties in the context of software development. For purposes of determining whether a software enables third-party interaction, the term third party generally includes any corporation, trade or business, or any other person that's not treated as the taxpayer for purposes of Section 41. But with one really important caveat, that for these purposes, third parties are not anyone or any company that uses the software to support the general and administrative functions of the taxpayer. And we have one good example of this from the regulations. Here we have a taxpayer that's developing software to interact electronically with its vendors to improve inventory management. So the taxpayer is developing software to enable it to interact with these vendors and allow the vendors to initiate functions or view data on the taxpayer's system. The taxpayer software allows vendors to request inventory of the vendor's products, and allows the vendor to send a message which informs the taxpayer that the vendor has just made a new shipment of the product to replenish the taxpayer's inventory. So here we have the taxpayer's vendors, and while typically you'd consider them to be a third party with respect to the taxpayer, they're actually not a third party for purposes of determining whether this is internal use software. So while this software is being developed to allow vendors to initiate functions or review data in the taxpayer system, the software was developed to allow vendors to support inventory management, which is considered to be a general and administrative function.
Yeah, I'm concerned that this will lead to disputes with the IRS that could be difficult. I mean, for example, if you're developing a program that allows customers to view their account and pay their bill online, could that be interpreted as simply being software that allows the customer to help with the accounts receivable function of the taxpayer and therefore bring you into the internal use software definition? Okay, now one aspect of the new regs, which I think is a difference, is there's a great deal of emphasis on the intent of the taxpayer and the facts and circumstances at the beginning of the software development in determining whether or not you're for internal use. If you read the preamble to the proposed and final regulations, you'll see that the IRS for software seems to be putting a great deal of emphasis on the idea that the credit is intended to be an incentive for research, and therefore they want to look at what was the taxpayer's intent at the time that they undertook the software development project. The regulations go on to say that, if you start with a development project that's for internal use, but you later make improvements with the intent that the software will be now used by third parties or sold to third parties, then you can treat those improvements as being a separate activity from the original software and would not have to apply the internal use software for that. The rule would work the other way as well. If you start out with a product that's intended for third parties, but then decide that there's going to be a part of the application that can only be used internally, you'd have to separate that out and treat it separately. I can see this incremental approach working if it's a case like you were building your overall system for doing your accounting, but then you decide to put in features which allow access by third parties to check the status of their orders or something, and you have a whole set of new software elements that deal with that. However, the regulations are not particularly helpful if you have a case where you start out thinking you're going to use the software purely internally, but somewhere along the way you go, wow, this is really great software, we should be able to sell it to other people as well. As I read the regulations, that project will never be eligible for the research credit unless you can satisfy the high threshold of innovation. In satisfying this requirement, you're going to have to pay attention to what your documentation is at the outset of your development project. Prior to the new regulations, there was not the same degree of being dependent upon what your documentation at the outset said. You could support it by other types of testimony of what you were doing. Now that may be not as possible. So I think this is going to put pressure on you to talk early with your software developers and try to understand what documentation they create and make sure that that documentation accurately reflects what your expectations are. In terms of documentation that we've previously seen that could be useful in this type of project, activity, there's typically something that we see labeled as a project plan or some other document at the outset of the project, which is giving the broad outlines of what the software development is intended to do. This, I think, is most likely to be the source where you would find documentation determining whether or not it's for internal use. Project plans, as I've seen them, often give sort of a plain English description of what the overall project's objectives are. And these documents I often find to be the most helpful generally in the research credit because they kind of give an outline under which all of the other activities are going to be folded under. So here's where I would expect to find documents that give information about how the software is intended to interact with customers. You may want to discuss with your engineers whether or not the forms that they typically use should be adapted in some way, perhaps to contain a specific question or prompt that requires the engineer to note whether or not the project is intended for a third-party use, and therefore that will make it easier for you to capture the information along the way. Mike, could you tell us a bit about the new category of dual function software?
Right. So in addition to the challenges presented by the time of determination rule, applying the new rules to the so-called dual function software has its own set of complexities. As we said, the regulations contain a new set of rules that applies to software that's being developed for use both in administrative functions as well as to enable a taxpayer to interact with third parties in various ways. And the regulations call this dual function software. And it's subject to the exceptions that we're about to talk about. In general, the regulations treat dual function software as internal use software. But they do allow taxpayers to identify a subset or element of that dual function software that does enable a taxpayer to interact strictly with third parties or allow third parties to initiate functions or review data, like the example we went over a moment ago with a customer ordering something from a taxpayer's inventory and tracking their order.
Now, I do think that this is going to be a problem for more taxpayers than what they may anticipate because I can see many software projects having dual function elements. If you're doing banking software, the same package that enables the taxpayer to set up his online bill payment may well also interact with the bank's accounting software to actually show the debiting of accounts, initiate the electronic transfer, and so on, thereby getting into aspects of the administrative functions. Similarly, the same taxpayer software that's used to track their inventory may well be part of the software project that allows a customer to be able to see whether their order has shipped. So you're going to fall into these needs to think about whether you can develop a third-party subset or use the safe harbor more often than you might have thought.
Right, and even if taxpayers are able to identify this subset of third-party interfacing functions of a dual function software, you still have to qualify the activities for that subset under the four-part test in order to get those expenditures to qualify for the credit. The regulations do acknowledge that it's going to be very difficult or sometimes impossible for taxpayers to partition this dual function software into neat subsets that only interact with third parties or alternatively only are strictly internal use. And so Bill alluded to this a moment ago, the regulations do have a safe harbor. And the safe harbor really allows taxpayers in situations where they can't identify a subset that's strictly third-party interfacing to claim 25% of the qualified research expenditures associated with developing that subset in computing their credit. But the hard part about qualifying for the safe harbor is that the regulations go on to provide that you can only qualify for the safe harbor if you can prove that use by third parties of this subset is at least 10% of the total use of that dual function software that you're trying to qualify for the safe harbor. So we have an example of how that would play out mechanically. Here we have a taxpayer who's developing software for use in an administrative function that supports the conduct of the taxpayer's trade or business and allows third parties to initiate functions. So it's developing dual function software. Here the taxpayer is able to identify a third-party subset. And in this situation, the taxpayer is said to have incurred $50,000 of R&D expense for the software, 50% of which is eligible to the third-party subset. So here, because the taxpayer is able to identify the subset that's third-party interfacing, the subset is not presumed to be internal use software. So under the regulations, the research activities that meet these, if they do meet the requirements of Section 41, $25,000 or 50% of the total $50,000 expense may be included in computing the taxpayer's credit.
Okay, now the example that Mike just covered unfortunately finesses the actual difficulties of how you're going to go about applying this by assuming that you can identify the third-party subset and what the cost is. I do think with effort you will be able to break down various subsets of the software. What I frequently have seen in software development is that an overall project will get broken down into a series of features, and each of those features then will have particular software engineers working on developing those features. So if you look at the documentation, I think it is going to be possible to try to develop certain lines of the overall project that relate, solely to a third-party subset, but it will require digging into the documents at a level which you may not have done previously. However, while I think there'll be documents that enable you to tell which parts of the software were intended for third parties. I'm more concerned with how you're going to go about tracing the costs related to those subsets. If you're using the type of overall cost center allocation that I see with many taxpayers, it may not be granular enough for this. If the software engineers are working in the same cost center but working on different features. So, I think you may need at the outset to make sure that your systems are going to be able to identify how a particular software engineer's wages are related to particular features that are there. As I say, I'm suspecting that to do this effectively, taxpayers are going to need to develop some additional systems to what they currently have.
Right. So let's go over an example of how the safe harbor would work, and with a pretty basic example here. So here we have the same facts as we had in the prior example, where a taxpayer is developing dual function software, except in this situation, the taxpayer is unable to identify a third-party subset. However, they are able to reasonably assume that at least 15% of the dual function software used is being used to interact with third parties. So here, although the taxpayer is unable to identify the subset, they do qualify for the safe harbor because they are anticipating that 15% of the dual function software used is going to be used by third parties. So to play this out, the taxpayer may include $12,500 of their entire $50,000 cost for developing this software in computing its research credit, because they're taking the 25% safe harbor for that portion that they're unable to identify.
Again, the safe harbor is going to have questions about how it will work in practice. One question I have is just, whether or not you want to look for a third-party subset or whether you just want to rely on the safe harbor. If you think your costs attributable to the third-party subset are going to be less than 25% of the whole, it may make sense not to undertake the effort to try to find a third-party subset in the first instance. Then, of course, there is the question of how you're going to determine whether or not 10% of whatever the dual function portion of the software is being used by third parties. As I see it, there's sort of a basic question of, use of what are you measuring here? What if you have a taxpayer who goes online, spends, 10 minutes reviewing his bank's website, but that requires very little processing power. It's mainly looking by the customer rather than computer power, and then actually sets up one online bill payment. Is it only the third party used? Does it cover the whole 10 minutes that he was on the website? Or do you only look at how much computer power is used when he actually clicks on the bill pay item? And then how do you compare that to all of the software that gets triggered underneath to actually update the bank's books, send the electronic payment, do whatever security systems the bank may need to keep track of it? Are you measuring, do you actually try to measure the processing time that the computer's using? Do you look at lines of code? The regs almost suggest that the number of interface screens might be important, but I'm really not sure that's a meaningful idea, because there may be a lot of interface screens for the customer and then almost no interface screens for all of this back office work that's being done, because that doesn't require an interface screen. It happens automatically. So I think it's going to be challenging to work with whatever your particular industry is to try to find a reasonable method of saying, here's how we've measured third-party use. I think the good piece of situation here is that the third-party piece only has to be 10%. And therefore, in many cases, it seems likely you should be able to get a reasonable case that an agent, or if necessary down the road, an appeals officer would go, yes, the company meant at least 10%. But I do think working out with your systems and how to measure what the intended third-party use is going to create new challenges as you prepare your research credit claims. Again, this is another instance where the emphasis is on what your intent is at the outset. They're not looking for you to measure how it's actually used at the end of the day. So the pressure is on figuring out what you did when you started the development. Okay, with this, we now are turning to what is actually required if you have internal use software to satisfy the high threshold of innovation test. Mike?
Right. So if you determine that your software is indeed primarily intended for internal use, you have to satisfy this three-part high threshold of innovation test. And those three parts are: the software has to be innovative, software development involves significant economic risk, and the software is not commercially available for use by the taxpayer unless they significantly modify that commercially available software in ways that would itself satisfy the requirements of the innovation and economic risk elements. And the regulations provide some additional clarifications on what each of these tests entail. The first prong of the test is this innovation test, and it requires that the taxpayer show the software would result in a reduction in cost or improvement in speed or other measurable improvement that is substantial and economically significant. Now, this isn't, you'll notice by the language itself, it's not asking taxpayers to show that their new software is unique or novel or innovative in certain ways, in the sense that it's a new type of software that accomplishes a particular task in a new way. It's rather asking for measurable objective standards that show, reduction in costs by numbers, by numbers of dollars, or an improvement in capacity, or improvement in speed. So it's really asking for more objective measurables here.
I mean, this does create a certain irony that a truly breakthrough project may not be as easy to qualify, because you might be doing something totally different and therefore not have a ready benchmark. I would expect in most of those cases there will be a way to quantify what the breakthrough improvement does, but you may have to look a bit to find it.
So as with other types of research activities, identifying and collecting the appropriate documentation is really critical. And so in order to satisfy the innovation test, we would recommend focusing, again, on project plans. We discussed project plans earlier in the presentation, and again, these are typical planning documents that you'll see often at the early stages of a research project, and they're really helpful in highlighting just the overall objectives and goals of that project. And they're written in non-technical terms a lot of times, and so for the non-engineer, these are often the most helpful types of documents. And these are helpful for satisfying the innovation test, because a lot of times they'll have a description of what they're trying to achieve in terms of cost reduction or other types of efficiencies in terms of capacity or computing power. Secondly, we also recommend looking to software requirements documents or software specification documents. These are often more technical in the sense that they're identifying or laying out specific requirements of the software in technical terms, but often the technical terminology will try and highlight the types of processing speed or capacity that they're trying to achieve, and might even highlight the differences between this new software over the prior versions. And so that's helpful in showing this objective measurable that they're trying to get after with the innovation test. And again, we've mentioned this several times, but it's careful to note here as well that this is perspective looking. The test does not ask you to go, once the software is finished being developed, to look back and measure whether you actually did in fact save costs or improve the efficiency of software. It's prospective looking.
Yes, I mean the presentation of this, again, may be an area where you want to try to help your engineers to make sure that it's going to be effective. I mean, for example, you might have a statement somewhere that, we're going to improve processing speed by 1/10 of a second, which, by itself may sound completely unexciting. On the other hand, it might be that the old process took 2/10 of a second, so that, a 1/10 reduction is actually a 50% improvement. So you would like your software documents to be highlighting that 50% number if that's the more significant aspect. Or you might want to make sure that they're talking about not the amount of savings per transaction, but perhaps the total number of this type of transactions that your company has in a particular year or period of time. So you may want to think about what the best way to present the information is for your company. We now turn to the second requirement, the substantial economic risk test. And I suspect that this is going to be the requirement that most companies will struggle with in trying to obtain the research credit for their software. The regulations specify that software involves substantial economic risk if the taxpayer commits substantial resources to the development and there is substantial uncertainty because of technical risk that such resources would be recovered within a reasonable period. As you can see, this definition has a number of terms: substantial resources, substantial uncertainty, technical risk, and reasonable period. That may be a source of contention with the IRS down the road as to whether or not you've met this requirement. The concept of whether resources will be recovered in a reasonable period of time is a critical recognition by the IRS. I think if you talk to most of your software engineers, you'll sort of get the answer, well, if you give me enough time and money, I can do pretty much anything. But in the real world, you don't have infinite amount of time. And that is where the risk of failure is going to come in most software development. The project might be feasible, but it will not necessarily be feasible in a time which will enable the company to capture the benefit what it is. The technical risk, I think, again, is going to depend on working closely with your software engineers to make sure that they articulate what the problem is. I've seen many software documents where the risk section is primarily, we don't have enough people, which is not going to be an answer the IRS will accept by itself, because that doesn't suggest that there's a technical risk. Now, often if you peel back the onion, you'll be able to get the point, why do you need that many people? Well, we're trying to develop, a speed processing that's 10 times what anybody else has done. we have peak volumes of data which are not typical in the industry, and we have to find new database structures that will accomplish it, and so on. So there are, I think, frequently answers to these problems, but they aren't necessarily going to be what the engineers are going to write down without some discussion with you as to emphasize, you know, what these risks are. It's also a problem that the engineers tend to be talking about what's possible. You know, I mean, when you're writing up in a corporate setting, the idea is to say, yes, we can accomplish this. They don't generally highlight what isn't, you know, what makes the success doubtful. And so you're probably going to have to coax out of them what these technical risks really are. For the economic portion of it, you know, as we've talked many times, I think you'll be able to find in the project planning documents, you know, budget types of information, which will give you some references to what the costs of the projects are. Technical risks, you may well be able to find data that's useful in minutes of meetings or presentations that give an idea for it. So those are the types of things that may be helpful in building your case. You may also want to look at what, you know, the speed of change in your industry is as a way of developing the argument of what the reasonable time frame for recovering your costs should be. But throughout all of this, I think it's going to be very important to communicate with the project development team early on to try to maximize the evidence that you have available. Mike, could you handle the last requirement here, the commercial availability?
Sure. The third and final element is the commercial availability test, and this in general prevents taxpayers from qualifying software that's commercially available. In other words, you shouldn't be able to buy a software package off the shelf and implement it into your system and get the credit for it. However, this test does allow taxpayers to satisfy the high innovation test if you're modifying that commercially available software in ways that would itself satisfy the innovation test and the significant economic risk test. So, for example, you know, the regulations clearly indicate that a credit claim for implementing a large ERP system would typically face scrutiny, and we showed you an example from the regulations that illustrated that previously in the presentation. But if your fact base makes clear that successful implementation of that system is uncertain or questionable or very technically difficult in certain ways, you still may have a basis for that claim as long as your uncertainties are technical in nature and that they meet the the other two prongs of the high innovation test, the innovation test itself and the significant economic risk test. In a lot of situations, companies will have large software development projects that might involve purchasing smaller software packages and using them and combining them into a larger platform. And those individual software packages are targeting certain specific functions, and they're serving as sort of components in a much larger system. So in that situation is a perfect example where you might want to explain to your agent that these are not, these are really components. You're making the argument that you're not buying this entire system from an off-the-shelf provider and implementing into your company. You're spending a lot of effort and time in identifying components that will, you know, that itself are certainly commercially available, but you have to provide, spend a lot of time modifying those components into a much larger system that might involve a lot of work and creativity in that regard. So with that, we have some concluding thoughts here. As we said at the outset, these new regulations do provide much-needed clarity on the definition of internal software, and that definition will help a lot of taxpayers avoid the more challenging high threshold of innovation test, particularly for taxpayers who are developing online applications or software that runs websites that interface with their customers. At the same time, establishing to the satisfaction of the IRS what the intended use of your software is at the very beginning of the development might be really difficult. Prior to these regulations, taxpayers really never had to do that. And as we said during the presentation, oftentimes software development projects are changing rapidly, and you never really know 100% for sure at the outset of a development project what exactly that program is going to be used for. On top of that, the new regulations leave certain unanswered questions regarding how to treat dual function software, as well as how to apply the application or apply the high threshold of innovation test to software that is indeed internal use. So in the end, to wrap things up, certainly this is sort of a case of whether the glass is half full or half empty, and a lot of that depends on the specific type of software that you're developing and the specific type of industry that you find yourself in.
Okay, we have a few questions. Several people have asked about whether it's possible to get a copy of the slide deck. It will be posted within a few days on our website. If you did give your contact information when you called in, we will be sending you a little follow-up which will have a link which will take you directly to the slides if you want to have them. And if for any reason you cannot find them, please send an email to Mike or myself, and we'd be happy to send you the appropriate link or a PDF of the slides. We have a question about whether the development activity that can be carried out outside the U.S. but borne by the U.S. entity. Unfortunately, the answer to that is no. The regulation, the statute is intended to support research activities in the U.S. You can do it the other way. I mean, I've certainly seen cost-sharing arrangements where the foreign subs are paying for a portion of the research that's done here in the U.S., but that does not hurt the credit. However, you must actually do the research in the U.S. To obtain the credit here. So, software development activities in India will not be successful on it. With that, I see that we've reached the end of our time for today. I do thank all of you for taking the time to attend our webinar. We hope that you found it useful. Thank you.